figure out how sandboxes go to 5-year-old parties. You got me on that one. Well, shoot, I had a presentation. I worked up over the last couple of weeks, but things have changed in the last 48 hours. So I think it's time to change my presentation. Look, I published this book, Nothing But Net, and I came here right after it was published. And this was the beginning of 22 when we were in a market meltdown. And you'll remember this, the NASDAQ tech stocks, beloved tech stocks, we didn't call them Mag 7 back then, we called them something else. We had different acronyms, but they were off as much as 40-50% that year. If you could have held your head, you could have stayed calm during that. And they were off at the first part of that year for good fundamental reasons. We had interest rates going from 0 to 100 or from 0 to 5% in a very short period of time. And there were very good economic reasons for that, at the time. But that was the gale wind force that those stocks, the highest quality stocks, faced. And to me, that was the step-in opportunity. So I'm going to spend a little time talking about the way I think about stocks, how you make money. You hunt for DHQs, dislocated high-quality companies. So I'm going to explain that a little bit, and I think we're getting into one of those DHQs. When I spoke at the Vegas conference at the end of last year, beginning of this year, I said there really aren't that many DHQs. I thought there was only really Uber, because it had a robo-taxi roadkill overhang on it. This perception that robo-taxis were going to obviate the need for ride-sharing. I thought that was wrong. I thought that was overly priced into the stock. There was one DHQ. We had an Uber bull market from the middle of 22 to the end of 24, including the Trump bump at the end. So you had these stocks that were, not all of them, but a good chunk of them had full valuations. Some cases, valuations were stretched, not all of them, but in some cases that was the case, absolutely is the case. So that's the setup going into this year. You had full, maybe stretched valuations. You bring a negative catalyst in and you get the sell-off that you've had. We're now in this group that I look at, internet stocks, we've now officially entered a bear market. We're now down 20% from peak, middle of February. And the catalyst has been, call it what it is, an administration that's purposely tanking the market. There are other things in there too. I get it. There's some technology shifts with DeepSeek. I understand that. But it's tariffs. And now the real concern, tariffs are part of the issue, but for a lot of tech, tariff isn't really a major factor. For names like Google and Meta, tariffs are irrelevant. And it's not like they're going to lose access to the China market. Facebook and Google got kicked out of that market long ago for freedom of expression reasons or lack of freedom of expression reasons. No, the concern in the market now is that we're tipping into a recession. Our firm thinks that the odds of that now are 35-40%. And I don't think we've gone through all the retaliations that we're going to see. So my bias is that the market as a whole, I'm going to start off with bad news and I'm going to end up with good news. My bias is that we got more down to go. We did, again, the setup here is we had a 2.5-year Uber bull market. Uber bull market with stretched valuations. So now you got a bear market correction. It doesn't go over in just a day. I don't know how this political stuff all plays out, but it'll probably take a while. And we've yet to really see the cracks. I've got a few pieces of evidence I can tell you about what I'm seeing in terms of consumer retail trends, advertising trends, travel trends, kind of the most discretionary parts of the market. I'm seeing those cracks, and they could get a lot steeper. So there's a lot of fear in the market, and we have yet to really have a bad jobs print. I think that bad jobs print, it didn't happen today. It's going to come, though. I think there's a probability greater than 50% chance that it comes. Try to never say anything definitive. It's always odds. Probability greater than 50% chance that we've got a bad jobs number coming in the next few months. There's a decent chance, I don't know if it's a probability, but 30-40% chance that we're going to have inflationary pressures because product prices are going to go up. We started the year at 4% unemployment. Inflation almost down to 3%. We'd almost squeezed this thing out. I think we're reversing on both of those. It's going to be terrible for stocks. It is terrible. It's reflected in the stocks today. So that's all the bad news. Here's the good news. As stock pickers, we keep our heads. We look for these kind of opportunities. There's a very nice gentleman named Bala who I met out in the hallway and who stopped me and seen me on Fox TV and or CNBC, and he made some very nice comments, and I just asked him how he felt about stocks, and he had such a great attitude. I know he's in the hall here somewhere, but he said he was talking with his daughter about, every 3, 4, 5 years you get these corrections in the market, and if you can keep your head, this is how you make money. This is how you take advantage of these opportunities. I think that's where we are now. So I'm going to go through a few of these slides, but this is really kind of overtaken by events, and I'm going to try to leave you with 3, 4, 5 stocks that, am I telling you to go in and buy them today full fist? Absolutely not. But do you start picking away at these stocks when they're truly dislocated, high-quality companies? Yes, you do. And what you're waiting for are the first rounds of estimates cuts, because I think they're coming. You probably get if you get a recession, you'll get a clear recession, you'll get a second round of estimates cuts. And it's somewhere between that first and that second cut that you can start getting super aggressive in these names. I look at all of you and the average age that I see in the room, which is about 32. And I know you've seen these cycles before, and you probably, like all of us, panicked in the first cycle or two and then kind of got used to it and were able to wade into the second cycle or two. I think we're at a point now, given our wisdom, not our age, our wisdom, where we can do the same thing here. So let me go through a couple of ideas here. Okay, this is what I say are our top picks. I'm going to shuffle this, though. Again, I'm sorry, the facts have changed in a 48-hour phase, and so as John Maynard Keynes once said, when the facts change, my opinions change. So I'm going to shuffle this list a little bit. Let me just see what else I'd want to just pull out here. I started the year saying I'm compound constructive on the internet sector. I thought the multiples could largely hold, but they weren't going to re-rate up from where we were, unless you had a few real outliers. Uber was that outlier. I think what I've seen so far in the December quarter prints were really strong. I think the companies are actually going to report reasonably good March quarter results. It's not going to matter. It's going to be about the June quarter outlook, and I think increasingly I would bet that management teams are going to be cautious about the June quarter outlook, and that numbers are going to start coming down. That's going to be the unlock, I think, on value in some of this sector. When I talk about high-quality companies, I don't cover Tesla. I don't cover Apple, and I don't cover Microsoft, and I apologize, but I never have, and I'm not going to give you a good opinion on those. I do cover, however, a lot of names, and there's about 40, 45 names, and I think there's about 11 of them. I call them the Electric 11 that performed really well in the past, but that's the past, that I think are really high-quality names. It doesn't mean they're all buys, but they're high-quality names. I look at 4 criteria when I try to figure out what a really high-quality name is. Tell me that you address a very large market opportunity. I want to see a track record of very good product innovation. This is the tech sector, after all. I want to see tech innovation. Third, I want to see a company with a really compelling consumer value proposition, so much so that when they raise prices, consumers adopt the price. Nobody likes a price increase, but there's very little churn. People are still very content because they think there's just a great value. I got a great idea for you. Netflix. It's probably the most recession-resistant name I cover. Look, the worst of it all comes when we go into a severe recession. $7.99 a month for access to the largest global entertainment bundle. People will hunker down in the worst cases, or that's probably about the last thing they're going to cut in their budget. And that's what Netflix offers you. I think you can pay more than $7.99 for a latte in downtown Dallas. I'm not sure, but I think you can. And you can just buy Netflix instead. So but anyway, I think about a compelling value proposition so powerful that companies have pricing power. And then the last thing I look for is really great management team. So again, those are the 4 characteristics I look for in a high-quality team. Tell me you're facing a really large market, ideally a TTAM, trillion-dollar TAM. Tell me that show it to me, that you've had multiple successes in product innovation. I think about Amazon, success in retail, success in cloud computing, an industry they practically invented, success in advertising. And then I'm very intrigued by what Starlink has done. It's fascinating. I think Amazon's going to be a fast follower in that space. We'll see how well they execute. But this company generally has executed extremely well in very diverse categories. So I think Amazon's a great example of a company with a really great track record of product innovation. Value proposition, I already gave you an example with Netflix. And then great management teams. These are very hard things to judge. It's more art than science. But I look for founder-led companies, preferably, but not always, management teams that are very sticky, consistent, have been there, especially if they've been through cycles. We're all better, we're all more experienced if we've been through the cycles. I want management teams that have been through the cycles too. Anyway, these are the electric 11. It's Airbnb, Google, Amazon, Booking, Trade Desk, DoorDash, Uber, Shopify, Meta, it's a funny symbol, Netflix, and Spotify. And what I'm waiting to see is which of these stocks gets really dislocated. So what do I mean by dislocated? I look for 2 or 3 things. We're at this point now. I look for companies that are trading at their trough multiples. I just pull up the tape. You know, you can find this on a Bloomberg or a FactSetter. There are other ways to do it. Google Finance will help you with this too. Look for companies that are close to the 3-year trough PE multiples, or price to free cash flow, price to sales, or price to EBITDA multiples. That's one thing I look at. Secondly, I always like to find companies that are trading at a discount to their growth rate. So the PE to growth, if it's less than 1, you know, the stock trades at, now, today, Meta is trading at 18 times next year's earnings. I think Meta is a 20% plus sustainable earnings grower. Companies don't for a long time, good high quality companies, they can trade below their growth rate, but not for a substantial period of time. So that's actually one of the ones I'd be stepping in and buying, you know, starting to chip away today. And then the third thing is, just as a quick rule of thumb, I look for these 20, 30% corrections. You know, what we're trying to do in markets is mitigate 2 risks. Valuation risk, did I buy it at too high of a price? And fundamentals risk, did I buy a good, well-run company, a good business model? And the way you mitigate both of those is to wait for the stocks to get dislocated and keep disciplined about those screens as to what a high-quality company is. All right, so let me, yeah, this is all the growth outlook. I think these are going to change. So let me go back here and let me just cut through, and I'm going to give you 5 ideas of stocks here. And you know, this is my reputation. This is what I've been doing for 27 years. Amazon or Meta would probably be my go-to stock right here, right now. So let me give you the pitch on Amazon. We have a $270 price target. My guess is that our estimates will probably come down, but I think like mid-single-digit %. There's tariff impacts here. And then Amazon's going to have to decide whether to eat some of those tariffs, pass them along to consumers. They'll probably do a little bit of both. Then the question is, how are consumers going to react to rising prices? Amazon has an enormously strong value proposition, so I don't think there'll be a lot of pushback from consumers on Amazon, you know, raising prices by 2 or 3%, but it's possible. Anyway, Amazon, $270 price target. Here's the simple reason why I like it. I've got 2 product cycles, 2 areas of acceleration, and then I've got an operating margin expansion story. So here's the 2 product cycles I'm most intrigued by. I want to, like, what's new about Amazon? It's this thing called Kuiper. That's the new product that will be launched to take on Starlink. The first launch will be in about 2 weeks. And Starlink has just proven that there's a massive TAM in satellite communications. Fastest company in history to go from 0 to 10 billion in revenue. I think that's right. It's darn close to right if it's not right. And I think that a fast follower in the space that's going to be screaming for, you know, diversified supply base, and Amazon's technology and the structural advantages they have with all of the data centers and distribution centers that they already have on the ground. Amazon also, of all the major tech companies, probably does more with the U.S. government and defense industries and intelligence agencies than any other. I think even more so than Microsoft. If you recall, the initial case, the initial example that really got AWS, Amazon Web Services, that proved Amazon Web Services had a viable offering was when they won this massive CIA contract. So anyway, I like this. That is a product cycle. The second one is Alexa. Alexa Plus, I mean. How many people here own an Alexa device? Show of hands, how many people own an Alexa device? Okay, so that's 52.3%, if I got that right. And how are we doing on time?
We're up to Q&A almost.
Okay, so I'm going to go through 3 stocks then. On Alexa Plus, as they roll it out, I think you'll have a first really good example of an agentic agent with a hardware device. There's 2 or 3 companies that really have the ability, I think, to do this successfully. Apple, Amazon, maybe Google, maybe Facebook, maybe Microsoft, but if it's a consumer device, probably not Microsoft. So I think we're going to see this product rolled out in the next few weeks. I'm intrigued by that. I think Amazon Web Services, the single most important part of the business, is going to show acceleration in the back half of the year, largely because I think the chip shortage that has held back their ability to match demand is finally being addressed. And then the advertising business, because of the turning on of Amazon Prime Video inventory, I think you'll see acceleration there. The operating margin reference I made was to the retail business. They continue in part because of automation, robotization. If you want to find the single largest deployer of robots worldwide, that company is Amazon, or it's one of the top handful of companies. And they're using that to gain better and better leverage. They're talking about in their most advanced distribution centers, their total cost to serve, fulfillment cost, shipping cost, all in per unit is 25% lower than in any other distribution center. It may not sound like a huge number, but 25% on billions of units is a massive cost saving for the company. So anyway, we'll have another year of operating margin expansion. Amazon number one pick. Number two pick, and I don't have a slide on it because I'm doing this real time, is Meta. So Meta actually, I think, is one of the most recession-resistant names I cover. People will cut advertising, but they'll start by cutting brand advertising. Then they'll start by cutting all experimental ad budgets. Maybe your TikTok will get cut. Your Snapchat will definitely get cut. Your Roku channels will get cut. But performance marketing channels will be cut last, and particularly Meta will be cut last. Extremely diversified in terms of its advertising base, less exposure to the travel vertical than at Google. That's why I think it's more recession resilient. Really powerful AI cycle going on at Meta. That's what's caused it to see nice rising engagement from users and rising ROAS, or return on ad spending, by advertisers. So Meta would be the second name. Now you're at clearly below, you're trading at a peg less than 1. I understand there's going to be estimates risks. So, I start buying a little bit here. I wait for the estimates cuts off of the March quarter prints, not on the prints, but really on the forecast. And then I wait in on that. And then I'll give you one last idea, and I'll stick with Google. I think when you get the high quality names trading off, you don't need to get speculative. So Google is now trading at 15 times earnings. There's 3 overhangs: DOJ, agentic AI search pressures, and then this belief that there's a lack of cost accountability at the company. It's been a long-standing overhang. But, kind of the heck with that. I think there's a greater chance of a deal between Google and the DOJ under a Trump administration. There may or may not be, but I think there is. I also think, more importantly, I think the worst case scenario has probably been taken off the table, which is that Google wouldn't be allowed to pay for distribution. I think they'll end up being able to pay for distribution, just not exclusive. So I think that overhang will be addressed. I've done quarterly surveys for a year. I should have been doing it for longer, but for a year. I haven't seen any material market share shift. I haven't seen any market share shift away from Google on commercial search queries. I want golf vacation packages in Maui, buying tickets to March Madness in San Antonio. Those kind of commercial search queries, Google share hasn't changed at all. That's where the money is. So I don't think there's going to be any change in Google's search revenue. And then I think people underappreciate the cost discipline that's occurring at Google. I don't think street estimates have this correct. So those are the 3 stocks. They're kind of the tried and true names, but this is the time when you lean into those names. So again, Amazon, Meta, and Google would be the 3 names, the best DHQ candidates I could suggest to you at this point. That's it, Keith.
Fantastic. Questions? Thank you very much, Mark. Ladies and gentlemen, any questions? Bala.
Hey, Mark. Great fan of your clarity of thought. My investing thesis for a while has been to aim for average returns for a more than average period of time. In your opinion, is there any reason for me to revisit that theory?
Revisit the theory of
average returns for more than average periods of time, waiting for more than average period of time.
I'm not sure I fully understand the theory, but I think you're the person I talked with, you're the person who inspired me earlier, is the way you think about your average entry points. So much of this is just getting the price right. The longer term investor you are, the less that valuation matters. The nearer term, the much more important it is to get valuation right. Part of my, I've always I have a lot of clients who do a lot of daily trades. They're called hedge funds, and I work with them, and they're very important clients to me. But for the vast majority of investors, I have a specific chapter in this book that says don't play quarters. So you want to look. You made a lot more money being long a name like an Amazon over years rather than trying to catch each of those volatile quarters. So I guess that's what I'd say to you. Yeah, you want to take advantage. You want to be more aggressive. You want to find your DHQ moments. You want to be upfront with people when there aren't that many DHQ opportunities, which was the case at the end of last year, beginning of this year. You want to look for these kind of sell-off opportunities, these kind of dislocations to step in. That'll end up allowing you to have a relatively low average entry price, which I think is what you're getting at. So in that sense, yes, I agree with your take.
Thank you, sir.
Thank you, Bala.
Wow, that was thorough. No other question. I've never seen that. This is amazing. Nobody's terrified yet, to Cody's point.
Right
we
here,
do
please.
have one more.
Hello, Mark. I got a question. So I read on Twitter this morning that 4.7 billion were bought in stocks yesterday. It was like the largest one day ever. This question, Trump 1.0 was bragging about the market. Trump 2.0, he says, I'm not worried about the market. My question is, do you think the NASDAQ will be higher at the end of the Trump term?
Yeah, you give me 3.5 years, yeah, I would say yes. I don't believe 4 billion, well, that could well be that 4 billion stocks were bought. I mean, you can't sell unless somebody's buying.
Bingo.
So I just want to know what the value, I think it's just a funny way of saying it. Yes, they were bought, but they were bought lower. That's the point, and that's why you had a sell-off. It wasn't a buy. Yes, it was a buy-off, I guess. There's just people bought it lower. And yeah, you give me a long enough term. Hey, I also make a point. I just want to make sure, there's this belief about whether we were in the AI extended overhype cycle. So just so we're clear, I may be completely wrong in this. I don't believe that. When I hear Google say that 25% of their code now is being generated by Gen AI, and then worked on by programmers, I mean, that's a massive efficiency improvement. When I hear Amazon mention that point that they're seeing a 25% lower cost to serve, fulfillment and shipping costs per unit in their most advanced automated distribution center, that's a massive AI data point. And then I look at these small little examples. I love this small little company called Duolingo. If you want to learn languages, you have children, grandchildren who want to learn languages, it's a wonderful tool. And they have they have a chat bot in there. It's all AI generated. They charge extra for it. It's a great service. My wife's on a medical mission now in Peru, and she just used that to kind of brush back up on her Spanish. But you're going to see more and more of these. I think we're at the BlackBerry phase of AI in terms of the applications. And so I'm very bullish on that. So that means I don't cover NVIDIA, but I don't know why I wouldn't be bullish long-term on NVIDIA. But I'm definitely bullish on Google, Amazon, and Meta as deployers of AI.
Before my question, just to add to your Google, I work for Google. First of all, operation efficiencies inside the company is phenomenal. Like, we use for everything. And if something was taking me to manage your team and do stuff 3 hours, you do it in 15 minutes with Gemini, number one. Number two is they're massively using it for coding. So it may be up to 40% or so where basically code is generated and the developer is using it as a QA just to make sure it's perfect, and agent AI is going to be big. My question for you is, Google, what is your thoughts about the acquisition of Wiz at such high price?
So they bought, it's the largest acquisition they've ever done, $32 billion, cold hard cash. It's nice to have $100 billion in cash in your bank account. I guess that's one point. I can't justify the valuation, but the three questions I had for a security software analyst, when I hear these kind of deals, I step back. Is this a high quality company? Just screen it, yes or no. Secondly, is this something they could have built on their own? And third, are there clear synergies between this company that you're acquiring and your core business? And the answer I got on all three of those was yes, no, yes, i.e. One of the highest quality security software companies out there. No, Google could have tried to build this on its own. It would have taken a long time. This is a path to market, accelerated path to market strategy. And then third is, I think there'd be enormous synergies with their core Google Cloud business. So I don't know about the valuation. And I guess right now they probably had wished they had bought it with their stock. No, is that right? Stock's fallen. But anyway, cash looks pretty good now.
And this last part is, you mentioned the three big companies. If you had to take any small upcoming companies or cybersecurity, what would you recommend?
Oh, I don't cover cybersecurity, but you know, there are other stocks that I like. So just real quickly, the stocks that I think are going to be most recession resistant. I mentioned one already, Netflix. Another one is Spotify. I also think names like Uber and DoorDash. They're sort of almost like tech utilities, consumer utilities, internet utilities. I think they have pricing power too, but I think their demand trends will hold in very well. So that really ultra defensive portfolio, I think would include names like those. Yes, sir.
Okay. First of all, thanks for being here. We really appreciate your talk and your insight on the stock market. You mentioned that you think the market still has a way to go down before it turns around. And you also said that in the next 3.5 years that the market you think will be up at the end of 3.5 years. I know I'm going to get a lot of people ask me, I don't panic, I'm a long-term investor, but I know I'm going to get questions when I get back home from people. When do you think, and I know we don't have a crystal ball, but when do you think the market might bottom out and start to turn around? That's number one. So I got 2 questions.
Well, I'll make the point. I think you need to have estimates cuts. And so, and estimates cuts would be based on the fact that sentiment has started to really sour, and you're going to see consumers pull back on spend and enterprise pull back on spend. And companies are going to start reporting earnings in 3 weeks. And when they do, next week, actually, I think some of the banks will go first. But as they go through and the companies report at the end of April and into May, they're going to be more and more cautious, is my guess. And so you first need, the market won't stabilize until you start getting estimates cuts. That's my take on it. And then it depends on the severity of the recession, how big the estimates cuts are. But as a minimum, you need a round of estimates cuts for the stocks to go up. There does come a point where stocks go up on estimates cuts, but that's after the first round of cuts. So you first need that. So at a minimum, I don't think you get stabilization in the market until middle of next month. But my prediction on that isn't really that helpful. I'm looking for the estimates cuts first. And I would also just keep in mind, it's very hard to call the bottoms on these. That's all right. Hunt for these DHQs. Find stocks that are trading, that are dislocated, that are super high quality. Am I going to get the bottom on Meta, Google, and Amazon? I doubt it. But if I can get the meat of the move, that's where you make your money. So don't worry about nailing the bottom, because I don't know anybody who can do that. But just hunt for those DHQs.